Roger Merz, most fund managers in emerging markets choose a top-down strategy. You follow a bottom-up one. Why is that?
Well, historically, emerging market fund managers have tried to forecast certain economic developments in certain regions and countries, and then derive from that which companies could profit from an economic recovery, for example. We go the other way because we believe it is very difficult to consistently forecast the economic development in certain regions and then try to find the best companies. What we do is we go the other way around. We start on a micro level, not on a macro level. We search for leading businesses, very dominant companies that have leading market shares, generate a lot of cash flow relative to their investments, and we look for companies that over time can use their strong and dominant market position to gradually increase the return on invested capital, which is what we believe in drives ultimately a share price. So if you compare, for example, China today, it's growing at 6.5%. It used to grow at sort of 6.8, 6.9%. Now, is this an area that is very fruitful for companies or not? 6.5% growth is still quite a lot, so it's difficult to assess which companies potentially could profit more from a slightly lower growth environment. We start on the other side. We look at companies that in pretty much any economic environment can do actually well by producing maybe goods or services that are sought after in emerging markets.
You made some interesting points. Even though investors tend to fear some emerging markets because of their exposure to commodities, are those worries overdone?
Yes, the emerging markets have changed dramatically in the last 10 years. If you look at emerging markets 10 years ago, it was all about commodities and energy and mining and oil, and they had a big index weight. If you look at the index weight today, it's all about technology and financials and consumer. So technology today is actually the largest sector weight in the emerging market index at 28%. Compare that to energy and materials combined at 15%. So energy and materials today are only half the weight pretty much of technology, and you can see that shift happening all across the board. For example, the Chinese government has a clear strategy to shift from old economy, i.e. steel production, cement, coal production, polluting areas, into in what we call the new Chinese-led economy, consumer-led economy, which is into internet, into technology, into electric vehicles, etc. So that perception is still existing, but we think it's wrong, and it offers great opportunities to invest in leading businesses that no longer have to do anything with what sort of emerging market was characteristic for 10 years ago.
Let's talk about sustainability. Sustainability is getting more and more important also in the fund management business. How do you address this topic in your fund?
Well, sustainability is an important aspect that we're looking for. We're using it on several fronts. We're using it as a risk management tool. We want to make sure we do not invest in companies that do not comply with a certain minimum standard that we require in terms of environmental, social or corporate governance standards. Now as well, here in the last 10 years you had seen a big shift. It used to be much more about environmental standards 10 years ago. Today, probably half of our work is concentrated on corporate governance standards. Are the companies up to the standards they should be having? Are we, as a minor shareholder in these businesses, treated fairly? There's a lot of questions around board independence, for example. So actually, the ESG that we use probably should be reversed, and it should be called G, S and E, because mostly, as you can imagine, a leading Korean company in the chemical space today, like LG Chem, for example, that we're invested in, they cannot afford to have no longer good environmental standards, and as a result, it's more about corporate governance and are we treated fairly as a small shareholder.
Roger Merz, thank you for the talk.